Hi there everybody and welcome to another stock analysis video. Today I would like to give an update on a company that I have not done for several months. I think this was like one of my first videos I ever did on the channel when it comes to the stock analysis, and that is Chevron Corporation. Now, we have seen an absolute rise when it comes to oil prices recently, reaching all the way up to around $130 per barrel. Now currently oil's actually pretty down under $100, which is actually pretty surprising. However, seeing that this did occur, I would like to see if Chevron's fundamentals actually match this current price, because it is high. It is very high right now as it stands. So with that said, let's get started with this analysis. We're going to go straight into the dividend summary, guys. I absolutely love Chevron, and their dividend is one of the reasons for it. Dividend yield of 3.32%, $1.42 a share, with an annual payout of $5.68. The payout ratio in regards to the net income, guys, is very high at 65.31%. We're going to see this in regards to the cash flow, and well, it's actually pretty high as well. Not even gonna lie, it's actually one of the highest we've seen on the channel so far. However, we're gonna get to that when we get to that. The 5-year growth rate on this dividend is around 4.82%, which they have increased this dividend for 6 consecutive years, which is actually fairly good. Now, their ex-dividend date was the 14th of February, payout date was March 9th, and they paid their dividends quarterly. Now let's head over to the calculator, guys. Ticker symbol of CVX, market cap of $325 billion, PE of 20.49. The last time we did this, I think they had negative PE if I'm not mistaken. Share price of $166.72. To give into perspective, when I was doing this company, it was like at around what, like 100 plus something, and I actually bought this company a lot, like $10,000 worth, at around a current share price at like $90. So I'm actually very high on this company. And when it comes to dividend payments, this company actually gives me the biggest dividend payments out of all of them. In fact, I'm going to put up a screenshot as to how much they paid me in the month of March, which is crazy. I believe it was $173 and some change. But nonetheless, guys, just because they can pay out a $5.68 dividend doesn't mean that they are able to afford it. The amounts paid in dividends every single year actually almost ends up being around $11 billion. And after this is paid, they're only left with around $987 million left, which unfortunately ends up being a whopping 91.74% out of their payout ratio in regards to their cash flow. This is very high. However, why am I still invested into this even though this payout ratio is this high? And the reason is because companies that are tied to a commodity, their revenues, their profits are going to be correlated to whether this commodity goes up and is going to go down. In fact, we're going to see something very interesting when we go to the fundamentals in this exact same way. So just something to note when it comes to commodity companies, oil, gold, right, precious metals, that kind of stuff, it really does fluctuate based on what the price of the commodity is at the time. So now, guys, let's head over to the fundamentals, starting off with the net income 5 years ago of $9.2 billion to 1 year ago of $15.6 billion. That is a massive increase of around 70%. And I have to point out the obvious here, guys. 2 years ago, they did a massive negative $5.5 billion, and 3 years ago they even went down to around $3 billion as well. Now remember what I just said, commodity companies, oil, precious metals, gas, their profits fluctuate based on what the commodity is at the time. And let's actually see if we can figure out where this negative income actually came from. And if we actually come over here to the 5-year chart on the crude oil futures, you can see something very interesting happening right there. I'm going to see if I can actually get the mouse. This is going to be a little bit difficult. But essentially at around April/May of 2020, guys, in addition to the whole pandemic thing, oil futures completely collapsed into the negatives. I believe it went as low as what, -30 or so. So that pretty much dealt a huge hit when it comes to their incomes, because imagine having to pay people to take away your oil because you didn't have enough storage to to keep the oil in the storage. Therefore, that is essentially why oil went negative. And as a result, we see a massive drop 2 years ago. Now, 3 years ago, this one's a little bit more of an outlier. I don't necessarily know what was happening here. However, the 2 year ago mark, we're going to see a drastic drop pretty much all across the board. Now let's head over to the free cash flow, the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $6.9 billion to 1 year ago of $21 billion. Guys, that is a huge increase of 205% with an average 5-year free cash flow of almost $12 billion. And here's the kicker right here, right? 2 years ago, they had really low free cash flow at $1.7 billion, mainly because of what I just explained. Oils went negative. Oil futures went negative, essentially bringing down the total average 5-year free cash flow. So again, this is where we come into a little bit of a nuance, right? We just saw that their payout ratio is at like 91%, but is it at really 91% because of this $1.6 billion that they did 2 years ago? Maybe the reason why it's so high is because this number is actually dragging down the average 5-year free cash flow, because I get the payout ratio in regards to the average 5-year free cash flow. So it really does depend on how you look at this and how you take these numbers, because 91% is giving you an average view of it. However, is this average view being misconstrued because of this 2 year ago number at 1.75? That's just something to think about. Next, we got the revenue 5 years ago of $127.5 billion to 1 year ago of $155.6 billion, increase around 22.1%. Pretty flat across the board. It's slightly going down, but I think this is because of the fact that 2 years ago oil futures went negative, so everything across the board pretty much went down when it comes to the revenue, cash flow, and income. So in my personal opinion, this to me is essentially a flat line. We don't really see much of a difference across the board. They might continue this in the future. However, guys, something interesting though, as I just said, since they follow oil, when oil goes down, they also go down. However, what has oil been doing recently? Now let's head over to the total assets minus the total liabilities. What this does is it essentially simulates if the company were to liquidate all of their assets, how much money would they have left afterwards paying off their debt, and of course, if they're even able to pay off their debts to begin with. Currently, Chevron has around $7 billion in the total assets minus the total liabilities, which is really good. In fact, guys, just look at this graph. 5 years ago of 823 million, all the way up to 7 billion. Now, they did have an outlier year 4 years ago, and then went straight down 3 years ago. But looking at this from a pragmatic sense, the graph is essentially going up. To me, this 4 years ago was an outlier. Again, I don't necessarily know what caused it, but nonetheless, the graph is going up, and they have been positive in the past 5 years, including this year as well. The average total assets is around $30.7 billion. The average total liabilities is around $26.2 billion. And the average assets minus the average liabilities is around $4.5 billion. Now let's head over to the silent killer when it comes to investing, the shares outstanding. A lot of people don't understand this, guys. This is essentially how much the company is diluting you as the investor if you own shares. If the company's buying back shares, it's giving you a bigger piece of the company. Therefore, you actually just get like a raise essentially because they're buying back shares. Now, when it comes to Chevron, unfortunately, they are increasing it slightly from 1.9 billion shares all the way up to 1.93 billion shares. It's a small increase from the 5 years at around 1.32%, and an even smaller increase from the previous year to the current year at 0.25%. The way that I see this, guys, is they're trying their best, in my personal opinion, to keep it as flat as possible, and I kind of like that, honestly. Even though it is still an increase and it's a negative metric over here, for me personally, I'm going to take this as a flat metric because 1.32% is not really that much of an increase at all, right? So this to me is, yes, they are diluting you, but let's face it, it could be a lot worse. And lastly, let's take a look at their cash and equivalents. Currently, guys, Chevron has $5.6 billion in cash equivalents with an average cash equivalents of around $6.1 billion. And now let's make our usual assumptions: low, medium, high, using 3 different factors: revenue growth, predicted share buyback, required rate of return. For the required rate of return, keep it the same across the board, 10% to match the S&P 500. Now, for the revenue growth, this I'm going to be taking kind of like an average from the growth tab from Seeking Alpha. And of course, the predicted share buyback, I'm going to be using the shares outstanding that we just saw, and I'm going to make some kind of assumption here and there. Now, for the low assumption, guys, I'm going to assume a revenue growth of 23%, and I'm going to say that they're actually not going to issue issue shares, but instead they're going to be buying back a little bit of shares at 0.5%. This comes out to be, guys, a target share price of $147.16. For the median assumption, I'm going to say a growth of 25%, and I'm going to say that they're going to buy back shares at 1%. This comes out to be a target share price of $157.07. And lastly, for my highest assumption, I'm going to assume a growth of 30%, projected share buyback of 1.5%, and this comes out to be $182.86. Now we need to adjust for debt. The way we do this is we take the cash on hand and add or subtract the net debt. And then we add that to the market cap that the calculator forms. In doing so, if the company has more cash than debt, then the target share price will go up. If the company has more debt than cash, then the target share price will come down. As you can see right here, they have more debt than cash. Therefore, for the target share price adjusting for debt, this number comes all the way down to $131.95 for the low assumption. For the median assumption, it is $141.79. And for my highest assumption, it is $167.50. Now, me personally, guys, I like to add a margin of safety to everything because I want to have a cushion. If you're a bridge builder and you want to build a bridge knowing that it needs to hold 10,000 pounds, you need to build that bridge for 15 or 20,000 pounds. Same principles apply when it comes to investing. Adding a margin of safety helps you negate future losses. Therefore, for a margin of safety of 5, 10, and 15%, for the low assumption, we would like to buy between $112 all the way up to $125. For the median assumption, we would like to buy between $120.52 to $134.70. And for my high assumption, we would like to buy between $142.37 to $159.12. Which, looking at the current share price, guys, at 166, pretty much just tells me that if you assume that my highest assumption is correct, then this is a pretty good buy right now. Even taking the target share price after debt, we are just there. And in fact, again, as I said, I bought this company when it was at 90. And if you were lucky enough, if you had the insight to buy this when oil went negative and this company fell to, I think, around like 50 bucks, you are sitting really pretty right now. Oh my god, you just bought at super low. I mean, when I analyzed this company, they had negative PE. Right now their PE is 20, which is just incredible to think about, right? Going from negative to 20, that's awesome. So it really is up to you. If you agree with my assumptions, then by all means, this is an absolute buy at the highest assumption. But again, guys, as I always say, these are my assumptions. You should not follow them. You should take this calculator. I have it available. In fact, I just put out a video earlier today explaining how to actually input every single part of the discounted free cash flow calculator. So if you have any doubt, you can find it there. What I highly suggest is everybody should get this calculator and put in the company that you want, and you should make your own assumptions. At the end of the day, every investment is the present value of all future cash flow. My assumptions are going to be different than your assumptions, and that's a good thing, because we're both different. And well, if you think that Chevron's going to do amazing, then you probably think 30% is low. If you're one of those people that believe oil is dead and we're going to go into EVs, then you might want to put negative revenue growth, right? It really is up to you. But that's just my assumption, and this is essentially my numbers when it comes to Chevron. Now, guys, since Chevron does pay a dividend, I would actually like to take a look at the dividends at current price. I did this in the last video. I had a dividend paying company, and what I did was I took the average US income per year, being around $68,000, and I brought it into the monthly income, which is actually around $5,725. And what I want to do, guys, is I want to see if we were to put 1 month from our monthly income from working into Chevron at the annual dividends per share at $5.68, how much would this actually be paying us in passive income? In doing so, this would actually buy us around 34.34 shares, which actually ends up being an annual dividends at around $195.05. Quarterly, since they do pay quarterly, this is almost a $50 dividend, guys. For $5,725, earning back $50 every single quarter, that's actually really good. And if you divide this to the monthly, this is around $16.25 monthly. I mean, currently gas prices are pretty high, but if you take into account the fact that this is paying you $16.25, this is paying you a pretty good chunky amount already of your gas bill, in my personal opinion, right? All in all, guys, as I said, I hold Chevron, my biggest dividend paying company. I actually really love this company. This is the only oil company I hold because I think this one is the one that has the best fundamentals overall. And I might actually do Exxon probably tomorrow because I kind of want to see if Exxon and Chevron, well, I want to see which one of these two is better, right? So that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites at BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. And in regards to YouTube, Odyssey, and Rumble, I have a Let's Play channel, link in the description below. So if you want to see me play some video games, Pokemon Legends Arceus, Blues TD Battles, please, you can follow me there. So with that said, peace out, and be on the lookout for the next stock analysis video.